Why do the hardest-working, highest-achieving individuals with premium university degrees systematically end up financially poorer in their 30s than those who completely skipped the elite academic track? You followed the traditional socio-economic roadmap perfectly, yet you find yourself living paycheck to paycheck, trapped by heavy monthly debt obligations that completely paralyze your net worth. The uncomfortable truth is that your elite higher education was marketed as an investment, but the hidden structural math tells a completely different story. Right now, your premium degree might actually be costing you more than a literal house, permanently altering the timeline of your wealth accumulation. In the next few minutes, we will expose the hidden behavioral illusions and career ROI miscalculations that traditional financial counseling channels deliberately conceal from you. By understanding this hidden systemic trap, you will discover the precise mechanism that is delaying your financial independence by a minimum of 12 years. The primary psychological trap begins with the prestige heuristic, where our brains falsely associate extreme upfront institutional costs with guaranteed long-term financial returns. Capitalistic marketing loops exploit this exact cognitive bias, aggressively convincing teenagers to sign lifetime financial contracts before they understand basic compound interest math. Welcome to the academic conveyor belt illusion, a systemic structure where you deposit massive amounts of financial capital upfront in exchange for a paper certificate. But once you graduate, you are immediately dropped onto a slower-moving corporate treadmill, where the interest math scales significantly faster than real-world promotion frequencies. When you look closely at the data, higher education costs have outpaced real median wage growth for decades, drastically lowering your actual career ROI. This discrepancy creates a massive delayed opportunity cost during the prime wealth-building decade of your 20s, which is your most valuable financial asset. Instead of allowing your early savings to compound positively, your monthly cash flow is cannibalized by student loan interest, neutralizing your asset accumulation velocity. Every single dollar sent to service an inflated educational liability is a dollar that cannot be deployed into wealth-generating assets like equities or real estate. This structural imbalance places you at a severe disadvantage, forcing you to run the financial race with an invisible weight holding you back. To understand how devastating this hidden drain truly is, we must look at the actual mathematical comparison between two entirely different life trajectories. Let us introduce Profile A, a high-achieving corporate professional who carries $100,000 in student loans at a 7% interest rate right out of college. Profile A secures a prestigious entry-level corporate salary of $70,000, which sounds impressive until the reality of monthly debt amortization sets in completely. If you are ready to dismantle the systemic illusions holding your net worth back and upgrade your financial intelligence with data-driven behavioral economics, hit the subscribe button right now to unlock our weekly Elite Financial Playbook. By joining our channel, you will gain access to real-world behavioral analytics and practical asset management frameworks designed to accelerate your true wealth-building timeline. When Profile A pays their monthly bill, they realize that a staggering portion of their hard-earned money goes directly toward paying off the accumulating interest margin. For a full decade, while their peer group might be investing, Profile A is merely fighting to get back to a net worth of $0. This structural drag means major life milestones, like buying property, starting a business, or establishing a robust investment portfolio, are delayed by several years. The psychological pressure of this debt also forces Profile A to stay in risk-averse corporate roles, trading their long-term potential for immediate paycheck security. This exact point of collision between fixed debt obligations and stagnant salary velocity is where the illusion of the premium degree finally shatters for Profile A. To fully dissect the mechanics of this wealth gap, we must now contrast Profile A against an entirely different trajectory, Profile B. Profile B completely skips the elite academic marketplace, bypassing massive institutional liabilities and entering a specialized technical field straight out of high school. Starting at age 22, while Profile A is signing loan agreements, Profile B is already capturing a predictable baseline income of $45,000. Because Profile B carries zero student debt, they instantly automate a consistent $500 monthly allocation into diversified low-cost equity index funds. By capitalizing on this uninhibited early timeline, Profile B unleashes the raw mathematical force of compound interest during their prime wealth-building decade. When you run the terminal numbers at age 32, the compounding velocity of Profile B creates a vastly superior net asset position. Profile B has accumulated an insulated liquid reserve of over $85,000, while Profile A has merely managed to crawl back to absolute $0. This critical head start grants Profile B the immediate liquidity needed to secure real estate or exploit high-return investment opportunities completely unhindered. The mathematical modeling clearly demonstrates that premium credentials without immediate capital velocity create a structural drag that delays true freedom. Even if Profile A secures rapid corporate promotions later, they can never truly reclaim the lost compounding physics of their early 20s. This disparity is further intensified by the aspirational lifestyle traps that typically target premium degree holders in major metropolitan hubs. To maintain the social illusion of their qualification, Profile A frequently absorbs massive overhead expenses, further compressing their actual savings rate. They are effectively caught in a secondary consumption trap, sacrificing their liquid capital mobility for the sake of empty peer validation. This creates an invisible psychological cage where high nominal earners remain structurally wealth poor, trapped on a continuous high-end hamster wheel. So how do you completely break this systemic cycle and claw back control of your asset accumulation timeline starting tomorrow morning? The solution requires moving past passive budgeting and implementing a highly tactical corporate-grade strategy called the asset matching framework. Step 1 demands that you treat your student loans as an aggressive corporate liability, utilizing automated refinancing tools to slice interest margins immediately. By reducing your interest rate from 7% down to market-optimized minimums, you instantly prevent capital bleeding and reclaim vital monthly cash flow. Step 2 introduces strict environmental control. For every single dollar you send to debt repayment, you must match it with a mandatory automated micro-investment. This precise behavioral default switch deprograms the psychological trauma of a negative net worth, forcing your balance sheet to build active equity concurrently. Tomorrow morning, open your financial dashboard and completely discard nominal salary figures to calculate your true career ROI using net asset velocity. Isolate your exact monthly interest drag, execute an automated refinancing block, and establish your mandatory asset matching channel to reclaim your timeline. The traditional prestige roadmap is a static 20th century illusion, but your real wealth-building velocity is dictated entirely by the math you control today. Stop trading your long-term capital mobility for institutional labels that structurally compromise your financial independence and delay your ultimate freedom. Take command of your absolute numbers right now, optimize your debt structure, and upgrade your financial intelligence permanently by subscribing to Economecha today.